Singapore's headline inflation in June fell to a near three-year low, hitting 2.4%. Analysts say this marks the start of an easing momentum in inflation, which will provide some relief for households. Nearly all categories saw price increases moderate in June. Now, higher quotas for certificates of entitlement, for example, led to cheaper cars and motorcycles, which brought down private transport costs. Petrol prices also grew at a slower pace. A strong Sing dollar also helped dampen the cost of imported goods. Prices of clothing and footwear, for instance, fell the most in June. Non-cooked food inflation also stayed below pre-pandemic levels.
Some of the essential services items saw a pullback in price increases, as well as travel-related services, as well as global supply of air flights also improved. So by and large, I think we can expect services inflation to continue to ease over the coming months, given that some of the domestic cost pressures, particularly on the labor side of things, is also softening.
The Monetary Authority of Singapore says core inflation, which excludes private transport and accommodation, is on a moderating trend. June's figure came in at 2.9%, lower than the 3.1% in May. It adds that the full-year forecast range for headline inflation is being reviewed and will provide an updated figure by the end of the month. Now, this has prompted some economists to lower inflation estimates.
Given the recent inflation numbers coming out, I do expect the MAS to revise slightly lower their forecast for headline inflation. Previously, they were looking at 2.5% to 3.5% range. I think they will probably narrow it down to around a midpoint of 2.5%. But I think they will most likely leave their forecast for core inflation unchanged. I still see core inflation averaging roughly around 3% for this year.